Our fourth panelist today is Andrew Redleaf, who has almost 30 years' experience as an options trader, an original founder of the Deep Haven Market Neutral Fund, and the creator of Whitebox Advisors. He brings a refreshing combination of insight, energy, and humor to managing a highly successful and creative family of hedge funds. He graduated from Yale University in 3 years with a BA and MA in mathematics and was recognized as the top mathematics student of his graduating year. I've known Andy for many, many years, and I'm tempted to tell some stories about him from Yale, but he would probably respond in kind, so I think I'll leave that alone. I also think this could get interesting because I fully expect that he will say something nice about federal deposit insurance.
Well, thank you. I actually, I want to put 4 quick points on the table and then probably sit down and engage the other panelists. There are some areas of disagreement. First, and I think probably most important point, I do view this story, both the expansion and the contraction, as primarily a story about a handful of too-big-to-fail institutions, on the order of magnitude of a dozen. Fannie and Freddie at the top, Goldman and Morgan Stanley at the bottom, and a few in between. The mortgage, there were ancillary institutions, mortgage originators, who were actually, in my view, dependent on these really creatures of the too-big-to-fail institutions, both on the way up and then their demise on the way down was really incidental to the financial crisis and the reverberations within the real economy. To get a sense, Goldman Sachs's balance sheet is a little less than $1 trillion. I think it's actually smaller, but their nominal balance sheet about $1 trillion. J.P. Morgan Chase, Citigroup, twice as big, 3 times as big. These are very large, but they're actually not orders of magnitude of different from many other institutions within the financial services that actually sort of control more money. So all of the big fund families, Fidelity, et cetera, are $1 trillion plus. And something like the hedge fund industry, which is really, it's always quoted as 8,000 firms, it's really 200, collectively is several $1 trillion too. So it's not sort of strictly bigness, and their centrality to the financial system is probably not essential in that we have other forms of intermediation that can have functioned on roughly the same scale. Second point, for basically my entire professional life, but at least since continental Illinois, we've mostly had a policy with regard to too-big-to-fail institutions of what you might call strategic ambiguity. As a policy choice, deliberately ambiguous, what institutions would get what kind of help in what circumstances. Even on the Fannie and Freddie side, it was always, the word used to be implicit guarantee, but even now, it's not explicit full faith and credit of the U.S. government. The term of art is effectively guaranteed. I don't know what effectively guaranteed means. I'm not 100% sure what implicit means. And this may seem like a duplicitous or wholly irrational policy, and I think it wasn't as bad. But the rationale. There is a little bit of rationale. I think it was an attempt to try and get the best of both worlds. On the one hand, mom and pop, non-financial businesses could get could go about their business, operate with confidence that the payment system wasn't going to break down, wouldn't worry about, where they kept payroll, et cetera, and had counterparties that they could transact with. And on the other hand, the ambiguity was supposed to, since it was not certain who would be saved under what circumstances and so forth, was supposed to introduce a little bit of discipline, and maybe since you couldn't count on the government, you'd have a little bit of market play and forces at work. Now, we abandoned that policy in the middle of September of 08 and went to any large, visible, important institution is going to be saved. And the limitations of that policy are apparent now. First of all, nobody likes, nobody sort of supports it intellectually. It's hugely unpopular, and it's an open question, sort of how well did it work? Well, it's kind of compared to what, as opposed to, in this crisis, as opposed to 10 years ago with the demise of long-term capital. A private liquidation of long-term capital was arranged, Fed cut interest rates, market bottomed 2 weeks sort of after that happened. The bailout of AIG and the adoption of the no institution can fail was in September. Markets bottomed in late March, maybe early April, with lots of collateral damage to the economy in between. But would the alternative have been worse? We can't really rerun the experiment. Third point, I think very important. Then and continuing, disclosure in the financial sector is horrible, absolutely horrible. And there are so many examples. One wonders where to start. You can start with the Treasury and Maiden Lane, the vehicle created for to facilitate the takeover of Bear Stearns. Literally, their 08 income statement is about 10 lines long. They had $30 billion of level 2 and level 3 assets, which means there's no ready market for them, but some of them have market inputs that you can guess. Some are guesses out of thin air, presumably. When it was formed, they had $30 billion. They have $5 billion in unrealized losses, and now they have 25, and that's sort of it. We also know 39% of their assets are California, 11 are Florida, but that's sort of what we know. And when asked, when Treasury Secretary Geithner was asked, why not publish it, he said, well, that would put the taxpayer at a disadvantage. I'm not sure how, given that. They have term financing for as long as they need it. They don't have to sell anything. None of them are sort of marketable securities. I don't see any reason why there couldn't be kind of line-by-line detail as to exactly what they have.